Welcome back. Today, we're cracking open the books on the Jinyan Kaolin IPO. This is a pretty significant player in China's mineral space, and it's about to hit the Hong Kong Stock Exchange. So our job today is to dig through all the data and give you the analysis you need to decide if this is a smart move for your portfolio. Let's get into it. So here's how we're going to break this all down. We'll start with the basics of the IPO itself. Then we'll figure out what this company actually does. After that, we dive into the financials, weigh the good against the bad, and then we'll talk about the wild game that is the Hong Kong IPO market. And of course, we'll wrap it all up with my final actionable strategy. All right, let's kick things off. Section 1, the Jinyan Kaolin IPO. We got to set the stage before we get into the nitty-gritty. Really, it all boils down to this one question, doesn't it? Are we looking at a golden opportunity here, or is there a hidden trap waiting for investors? That's what we're here to figure out. We need to know if the business is solid and if now is the right time to jump in. Okay, moving on. Before we even glance at a spreadsheet, we have to understand the business. I mean, how on earth does Jinyan Kaolin actually make money? What's their secret sauce? So the entire business is built on this one specific material, coal series kaolin. And you might be thinking, it's just a type of clay, right? Well, not exactly. Because this stuff is found alongside coal, it's got these incredible properties, like being super resistant to heat. That makes it absolutely essential for some really heavy-duty industrial work. What's really key here is that Jinyan controls the entire process. Think about it. They dig the stuff out of their very own mine, which, by the way, has about 16 years of stuff left in it. Then they process it all themselves, and finally, they sell the finished product. We call this a mine-to-market model, and having that level of control is a massive, massive advantage. So what are they actually selling? Well, it pretty much boils down to just two main product lines. You've got precision casting mullite, which is used for super high-tech stuff like airplane engine parts or even medical implants. And then you have refractory mullite for making things that need to withstand insane heat. Now this focus, it's a classic double-edged sword. It means they're experts for sure, but it also means they have all their eggs in just a couple of baskets. All right, so the business model seems focused and pretty solid. But the big question remains, does it actually print money? It's time to follow the trail and see what story the numbers are telling us. Let's dive in. Okay, just at a quick glance, things are looking pretty good. You can see the revenue there showing some nice, steady growth. That's what we like to see. But hang on, take a closer look at that bottom line, the profit. It's not just growing, it's accelerating a lot, especially in this last year. And this chart just makes it crystal clear. Look at that. Revenue grew a very respectable 29%. Solid. But profits, they exploded by a staggering 115%. Now, what does that tell us? It tells us the company is getting way more efficient. They're squeezing more profit out of every single dollar of sales, and that is a fantastic sign of good management. But hold on a second. It's not all sunshine and rainbows. We've got to talk about debt. This number you're looking at is the gearing ratio, and at over 42%, well, that's a little on the high side. It means they're leaning pretty heavily on borrowed money to run the show, and that always adds a layer of risk we need to be aware of. And this right here is a pretty big deal. You could call it a red flag. In both 2022 and 2023, the company actually had what's called net current liabilities. In plain English, their short-term debts were bigger than their short-term assets. Now, they've fixed it since, but that history points to some potential cash flow problems, and that's something we can't ignore. Okay, time to put all the pieces together. Let's weigh the bull case against the bear case, stacking up the good against the bad, and see where we land. This slide really lays it all out, doesn't it? On the one hand, in the plus column, you've got these incredible reserves, total control over their supply chain, great R&D, and a solid team. But in the minus column, you've got some heavy hitters. This is an expensive, tough business to be in. There are always dangers in mining. And then there's that product concentration and the history of liabilities we just talked about. And hey, you don't even have to take my word for it. This quote is straight from the horse's mouth, the company's own prospectus. When a company tells you point blank in their legal documents that they might have liquidity risk, you absolutely have to sit up and pay attention. That is not something to gloss over. So we've analyzed the company inside and out. But you know what? That's only half the story. Now we have to talk about something else entirely, the Hong Kong IPO game. Because trust me, in this market, a good company is just the price of admission. It doesn't guarantee a win. So let me ask you this. In Hong Kong, is having a great business the only thing that matters for a hot IPO debut? The answer is a huge, resounding no. Not even close. There's this whole other metagame going on that's all about market structure, hype, and speculative patterns that can make or break a stock's first day. You know, the savvy investors who play this game, they look for certain tells. For instance, this no green shoe, no cornerstone setup, that can sometimes be the signature of what we call a monster stock. You also have to look at the sponsor's track record. Some are better than others. And weirdly, sometimes if everyone wants in and the subscription ratio goes through the roof, it can actually backfire on day one. It's a strange game. So let's run Jinyan through this checklist. Green shoe? Yep, they've got one. Cornerstone investors? Yes, 3 of them, which is a good sign. So what does this tell us? It tells us this isn't one of those wild, speculative flyers. This is a standard, by-the-book IPO. Solid, stable, but probably not a lottery ticket. Okay, we have done the deep dive. We've looked at the company, we've looked at the market game, so now it's time for the bottom line. What's my final verdict? What is the actionable plan? Here it is. My final verdict for Jinyan Kaolin is a solid 4 stars. It's a good company, but, and this is a really big but, it's not the only game in town. There's another big IPO, Lemo Services, happening at the exact same time. And based on my analysis, that one's a 5-star opportunity. That context is crucial. It makes Jinyan the secondary priority here. So how do we play this? Well, it depends on your setup. If you're someone who has a lot of brokerage accounts, the strategy is to go broad. Sprinkle small cash subscriptions across all of them, but make sure you're focusing on Lemo to get the best shot at an allocation. Now, if you only have 1 or 2 accounts, you absolutely do not want to go all in on one. Split your capital, maybe 70-30 or 60-40, with the bigger slice going to Lemo. Hedge your bets. And one final word on using leverage or margin. There's a smart play and a power play. For most people, the smart play is to max out your retail subscription. That's Group A. You usually get more bang for your buck. But if you've got serious capital, the power play is still a big Group B subscription to get a much larger allocation. The most important thing, your action item, is to check with your broker about margin financing. Like, right now. These things fill up fast. You know, this whole situation with Jinyan is a perfect lesson in investing. The question isn't just, is this a good company? The real question is this the best place for my money right now? Because with a solid but not spectacular opportunity like this one, sometimes the winning move isn't to go all in on a single bet. It's to play the entire field,